So last part is the hedging of interest rate risk. We have the FRA, the forward rate agreement. What is forward rate agreement? It is an agreement, okay, agrees the future interest rate, but it does not agree to borrow or lend the money. Forward contract is not the same. Forward contract means you had to borrow or lend the money, but here is to agree the interest rate only, but it does not agree to borrow or lend the money, which will be arranged separately. And what's the interest rate futures? As with all futures, an interest rate futures in agreement to buy or sell some commodity at a fixed price sometime in the future. The commodity is usually the government loan stock. So interest rate future, the underlying stock is the government's loan stock. Okay, so here, if you, for example, you buy interest future, you buy interest rate futures, you mean you are buying the underlying asset. Okay, we will show you some examples later, depending on you are the borrower or the depositors, what you have to do to buy or to sell interest rate futures. And we remember the price, I mean here is the government T-bills. The price drop when the interest rate going up. Okay. On the contrast, if the price is going up, then your interest rate or the yield is going down. Okay, here is the relationship you have to bear in mind. So, for example, borrower's case. Borrower's case means the risk is the interest rate going up, right? So it means the price of the government bond is going down. Here's the risk. So how to make profit by the interest rate futures? You have to sell the futures, because sell the futures, you mean you profit, or you will make profit when the price is going down. Make profit when price is going down. So here you sell the interest rate futures, you determine the futures delivery date and futures price, and also calculate number of the contracts. So it's very similar to currency futures. Okay, but the difference is you have to identify you are the borrowers or the depositor. If you are the borrower, okay, you sell it, you sell the interest rate futures because the underlying asset, the price should going down in order to make profit from you. Also consider take value. At a later time, the cash market transaction, the actual borrowing, you may be suffer by the interest rate increase, but you are making profit in the futures gains. So the net interest payment will be reduced. But if in other case, the cash market, actual borrowing maybe, for example, is benefit to you, the interest rate is dropping, and then your future position will be making loss because you are selling the interest rate futures, but the underlying asset, the price is going up, so you're making loss, then the net interest payment will be different. If you are the depositors, it is the opposite of the borrower's case. In this time, you are the depositor. Okay, your risk is the interest rate is going down, right? If interest rate going down, the government bond or the price of government T-bill will be going up. So in the futures market, you are buying interest rate futures if it is if the interest rate is dropping, and then the price of the government T-bill will be increased, so you're making gain in the futures market to offset your cash position. And next is determine futures delivery day and futures price, and then calculate the number of contracts, also take value to be considered. So cash market transaction, and also the future gain and loss. This all together will give you the net interest payment or net interest received. All right. So we move on to the last part, is the interest rate options. In traded interest rate option, same, gives the right but not an obligation to the holder to buy or sell an interest rate futures up to the agreed future date at a specific price. So option, interest rate option is interesting. The underlying asset is not a government T-bill. The underlying asset is an interest rate futures. It's different from the currency option. Currency option, the underlying asset is the currency itself. But for the interest rate options, the underlying asset is the interest rate futures. Okay, we remember it's the difference. So here we repeat again. It is actually an option on futures, unlike currency. Okay, so the other we'll talk is about the OTC over-the-counter option. For over-the-counter option, we have different category to be shared. These are longer term hedging techniques for interest rate, usually more than 1 year, maybe you say 2 to 5 years. Then we are going into 3 types: caps, floors, and collars. For caps here, there is an upper limit to the interest rate that will be paid on a loan. So interest rate cap means okay, you will receive the money if the interest rate is higher, going up, say here going up, above your specific rate. Okay, for example, 5% is your cap. It means once the interest rate is going up or and above 5%, you will receive payment in order to ensure your net position is limited to 5%. Okay, here's the upper limit of the interest rate that you have to pay on a loan. So here the interest rate cap means, it means to cap the interest payment based on the interest rate. And the other is floors. Floors for the depositor. Okay, and for the caps is for the borrowers, because you are scared about the interest rate increased to an unlimited part, so you would like to cap it by a cap. And for the floors, it is for the depositor, because they don't like to see the interest rate going down and going down, because it will affect their income. So the depositor would like to ensure the interest rate movements is not below what they would like to have. For example, the floors can be, say, 3%. So what a rate below the 3%, depositor will receive payments from the counterparty in order to ensure he or she can receive the minimum 3% of interest income. But he will enjoy the upside. For example, if the interest rate is going up and up, he no need to concern about his floors, and normally he needs to compensate the others. For callers, it's a bit complicated. For callers, it means if you are the borrower, it means you buy a cap. Buy a cap means, okay, you limit your interest rate payment or the interest payment, or you limit your interest rate level, say 5%. You buy a cap. Okay, you have to pay for it. Okay, for caps and floors, you have to pay for it, and then you have the right to receive the money from your counterparty given the condition is triggered. But for the callers, first of all, you buy a cap. Okay, callers for borrower, and the second is you sell a floor and receive premium. So in other words, it is a low cost or a relatively low cost option strategy. But if you sell a floor to receive the premium, it means what? It means you cannot enjoy all the benefits from lower interest rate. All right? You cannot enjoy the full benefit of lower interest rate. So it's the disadvantage of callers. But the total cost of a caller is much lower than a cap because you receive the premium when you go into the caller contract. Okay? If it is the depositor case for callers, we call it's a reverse callers. Okay, it's the opposite. Okay, you buy a floor and then you sell a cap. So all the work is done in the opposite way. Okay, we finished this management topic. Okay, we share a lot on the risk management instruments, and also we describe term structure theories. So let's take a recap. Okay, we talk about the instruments for managing exposures. For example, options, forward contract, futures contract. Okay, in general, we mentioned about it, and then we go into the term structure of interest rate. Okay, it also we name as yield curve. Remember the yield curve? Okay, we have mentioned about 3 different theories. Pure expectation theory. We also mentioned the liquidity premium theory. We also mentioned the market segmentation theory. Okay, so remember there are 2 types of yield curve. Okay, normal yield curve is upward sloping. Okay, also we mentioned about the downward sloping or the inverted yield curve. Okay, we also explained it. And after that, after the yield curve, we mentioned, we discussed into the theories of exchange rate determination. Remember? For the exchange rate determination, there's 2 theories which are in your formula sheet, which is the PPP, the purchasing power parity, also the interest rate parity. We explained the details of these 2 different types of theory. We mentioned about the spot rate, okay, the spot rate, and also the expected future spot rate. We also mentioned the forward rate. Okay, for this theory, we also mentioned the 4-way equivalence model in the foreign exchange market. So after all this completed, we go into the hedge. Okay, we go to hedge. We discuss about different hedging methodology for forex and also for interest rate. For forex, we mentioned about the forward hedge, money market hedge, the currency futures. All right, options, FX, the foreign currency, and also we mentioned the interest rate hedge. Okay, forward rate agreement, the options, also futures. Okay, and also we mentioned about the OTC, the over-the-counter market, the caps, floors, and collars. Okay, here what we discuss here. Okay, I promise you they sometimes in examination. Okay, for to ask students how to differentiate between different financial instruments on hedging the exchange rate risk or the interest rate risk. Okay, so here is for the class today. Thank you for joining.